Our guest today at MoneyShow is Doug Gerlach, small cap expert and editor of Small Cap Informer. Thank you for joining us.
Thank you for having me.
At the start of the year, you chose two stocks as top picks for 2017, Acadia Healthcare and Five Below. They have risen 37% and 22% respectively. First, let's look at Acadia. What was your reasoning behind this recommendation?
Acadia Healthcare is a provider of behavioral health care services, including treatments for addiction and mental health issues. And while most investors don't know Acadia, they're one of the largest operators of behavioral health facilities in the United States, whether you look at them by revenue, location, or number of beds. But there's a lot of fragmentation in this part of the industry. So Acadia's expertise really is in acquiring facilities and then upgrading those facilities and expanding the number of beds in those facilities. That helps them to reduce their overall operating costs and increase profitability. But it's this acquisition strategy that got them into some trouble at the end of 2016. They made a large acquisition, the largest in their history, of 300 behavioral health facilities in the United Kingdom. This purchase subsequently triggered an anti-monopoly investigation by UK regulators. In the end, Acadia agreed to sell off just 22 of the 300 facilities that it had purchased as part of that investment there. But that made them record a loss on the overall sale, and they took several other charges related to the divestiture. And as a result, their share price really took a nosedive on the announcement, reaching the low 30s. But in our view, this was really too severe based on the size of the company's UK business, its overall strategy. And so for us, this was a real mispricing that created an opportunity for investors.
Could you share an overview of developments at Acadia since the start of the year?
In the company's first quarter, which ended on March 30th, revenues were up 10% over the first quarter of 2016. Adjusted earnings per share were down 16% after the charges related to the divestiture and some impact from the weakening British pound. But this was in line with analyst expectations, and in the same period, same facility revenues were up a very strong 4.8%. So we're looking at some further improvements in the operating margin of the company as it realigns its focus following the distractions of last year. So they look like they're going to be on track for the rest of the year to meet their expectations.
Given the stock's strong performance so far this year, do you still recommend it as a buy?
Well, there is certainly some uncertainty in the entire healthcare industry, but there's no doubt there's a growing demand for Acadia's healthcare services for behavioral health issues, mental health issues, addiction treatment. So we see the ability for the company to raise the private insurer reimbursement rates by 4 to 6%, and Medicare reimbursement even up to 2% for this year. And we're hoping they'll be able to negotiate those price increases, which are going to really help on the bottom line. As long as they're able to continue to improve margins, that's going to give them a solid baseline for growth. And while the company is conservatively expecting earnings to be about flat for the year compared to 2016, if they do make any additional acquisitions, they could really have a big fundamental impact on its overall performance. And we're still seeing long-term opportunity here for sure, and are recommending investors buy ACHC up to $48.
What was your original rationale behind choosing Five Below as a favorite for 2017?
Well, we started covering Five Below, which is a specialty retail chain. We started covering them in December of 2016. We were really impressed that this is a bricks and mortar retail industry that's showing a lot of strength as the overall retail, especially the large department stores, are getting hammered by Amazon and other online retailers. So in a lot of ways, Five Below, we see them as an anti-Amazon play. This company sells products aimed at youngsters. They're all priced below $5. Its customer base is too young to be using and being big consumers of online retail. So the products that are sold at Five Below, additionally, are really too inexpensive for the big online retailers to maintain margins after you factor in the cost of shipping and fulfillment on those items. So you put that all together, it really gives Five Below a competitive edge. They have a niche in the market that they're serving quite well. And when you take a look at their pre-tax profit margins averaging 11% and expanding a little bit, you can really see the strength of this business model.
What's the outlook for Five Below now, and do you still recommend the shares?
Well, the company has just 500 stores in the U.S. They went public in 2012. They're primarily located in the East, the Midwest, the Southeast, some presence in California. So there's plenty of room for the company to grow and expand the brand. In fact, the company says they expect to have eventually 2,000 stores all over the U.S. So from that current base of 500, that gives them a lot of opportunity to grow. In their first quarter, which ended on April 30th, the company saw sales grow more than 20% and earnings were up 25%. So we really see the potential for earnings to continue to grow at Five Below at a 17 to 20% clip over the next few years. So that means we're buyers of the stock up to about $53 right now.
This is Zach Levine with MoneyShow, and we've been speaking with Doug Gerlach, small cap expert and editor of Small Cap Informer. Thank you for your time.
Thank you, Zach.